Banks did finish the day lower after the 10-year yield hit levels not seen since 2011.
Joining us now to discuss what banks are attractive in this environment, John McDonald from Sanford Bernstein. McDonald's has just been ranked this year's #1 banks analyst by the Institutional Investors All-America Research Team. Very good afternoon to you. Thanks for joining us.
Good afternoon. Thank you.
Congratulations on the ranking.
Thanks very much.
Let's dive into, before we go into the stocks, just on your view on the sector as a whole at the moment. I mean, just looking at the KBW Banks Index, it's essentially flat for the year. So banks are really struggling to find direction. What do you view in terms of the valuation of the sector as a whole? A lot of people suggest it's pretty attractive at the moment.
I think it is. I think the group feels pretty washed out. If you went into this year and I was telling you that we're going to get 4 rate hikes, deregulation, tax reform, and the economy is going to do a little better than you thought, most people would say, wow, I should own some financials. And maybe too many people did because they have underperformed. But they've underperformed by 8%. The sentiment feels pretty washed out right now. The group is trading about a 35% discount to the market. We're getting into earnings right now to start on Friday, as you previewed. And I think the earnings are going to be okay. And I think okay might be good enough at these valuations.
And when we consider the interest rate environment, as we were just discussing with Eamon, is that one of the key factors, do you think, that's influencing these stocks, whether it should or shouldn't? And is the outlook going forward attractive enough to justify a kind of buy rating?
Yeah, I think throughout the year, a flat yield curve had depressed the sector, and the concern was that the bond market was telling us something about the economy. And now that the 10-year has come up and the curve is steepened a bit, it seems like the bond market's saying, hey, maybe this economy is more sustainable at this level than we thought. That should be good for bank stocks. At the same time, the Fed's front-end increases on short rates are helpful. Not as helpful, and that's one thing bank investors have fretted about. In the beginning of the Fed hikes, the banks were getting 100% of the benefit to their net interest margins from each rate hike. Now they're getting about half. Eventually, they won't benefit any more from rate hikes, but they still probably have 3 or 4 hikes left where they'll benefit from rising rates on the short end.
The fact that we have had this underperformance, despite all those factors that, 8 months ago you would have thought would have actually supported the group, has it caused investors, your clients, to sort of question what's really going on in terms of how these banks work in this kind of economic environment? In other words, do they not have the leverage they used to a growing economy? Are credit costs just going to pick up from here? I'm just wondering what the rationale is.
Yeah, I think the rationale is they're cyclical companies and they're close to peak earnings. They've enjoyed the benefits of those rate hikes without having to pass on the costs yet, and credit costs are at record lows. So the margins can't get much better from here, and I think that's a fair assessment. So I think I would be tactically overweight into the quarter because I think they're oversold, and then after the quarter, I would be overweight the names that are under-earning relative to the group, because the group as a whole, banks are no longer under-earning.
Like who?
So Citigroup, for example, JP Morgan's the gold standard. They're doing a 17% return on tangible equity today. Citi's doing 10.5%. Citi would like to cut half the distance between them and JP Morgan over the next 2 years. And I think that's doable to get to 13.5 ROE, while JP Morgan's at 17, Bank of America's at 15.
Is Mike Corbat already doing the right things to get them there, or are there more changes that need to happen?
I think he is. I think there were some things that needed to happen first. They needed to upgrade their technology, rationalize the franchise. I think there's been a step up in intensity recently. They've had some Value Act and some other active investors have stepped up and said we need more intense execution here. I think Corbat is at the time now where that's going to happen. They're on the doorstep of, I think, improving net interest margin when other banks' net interest margin might be slowing down.
Which of the investment banking names do you prefer?
So I follow the universal bank. So in the capital market side, it would be Bank of America and Citigroup. Bank of America still also has a little bit of room to catch up towards JP Morgan. And I think the big banks as a whole are gaining share these days of consumer deposits versus small banks. They're leveraging their technology, their big brands, and they're actually disrupting themselves by changing the way they do business and capturing millennials and others through their mobile apps.
Overall, regionals versus some of the bigger ones that you're talking about?
Yeah.
Which is a better bet?
I would say the big banks, Sarah, on this view that they are able to leverage their brand, their technology to gain share. And they're also not as dependent on just on loan growth and net interest margin. They have a more broader business mix.
Just want to touch on the regulatory environment, because clearly the smaller banks have benefited from some deregulation. Jim Cramer interviewed Jamie Dimon recently, who was kind of making the point that the big banks haven't seen that yet. Is that something that you think will arrive, and how big a extra kicker could it be to the sector as a whole in your picks?
Yeah, there's not a lot of political support to help big banks, but there has been a changeover of the regulatory heads at all the agencies, and I think that they're interpreting the rules to tailor things better to banks' individual risk. So I think that could help. somewhat on capital return, somewhat on the amount of liquidity big banks need to hold, but it'll be tailored, it'll be company specific. I don't think there'll be a big wave to help big banks.